Today, we will talk about limited liability definition and how it works in corporations and businesses. Limited liability is a type of legal structure for an organization where a corporate loss will not exceed the amount invested in a partnership or limited liability company. In other words, investors' and owners' private assets are not at risk if the company fails. In Germany, it's known as Gesellschaft mit beschränkter Haftung, GmbH. The limited liability feature is one of the biggest advantages of investing in publicly listed companies. While a shareholder can participate wholly in the growth of a company, their liability is restricted to the amount of the investment in the company, even if it subsequently goes bankrupt and has remaining debt obligations. When either an individual or a company functions with limited liability, this means that assets attributed to the associated individuals cannot be seized in an effort to repay debt obligations attributed to the company. Funds that were directly invested with the company, such as with the purchase of company stock, are considered assets of the company in question and can be seized in the event of insolvency. Any other assets deemed to be in the company's possession, such as real estate, equipment, and machinery, investments made in the name of the institution, and any goods that have been produced but have not been sold, are also subject to seizure and liquidation. Without limited liability as a legal precedent, many investors would be reluctant to acquire equity ownership in firms, and entrepreneurs would be wary of undertaking a new venture. This is because creditors and other stakeholders could claim the investors' and owners' assets if the company loses more money than it has. Limited liability prevents that from occurring, so the most that can be lost is the amount invested, with any personal assets held as off-limits. The actual details of a limited liability partnership depend on where it is created. In general, though, your personal assets as a partner will be protected from legal action. Basically, the liability is limited in the sense that you will lose assets in the partnership, but not those assets outside of it. The partnership itself is the first target for any lawsuit, although a specific partner could be liable if they personally did something wrong. Another advantage of an LLP is the ability to bring partners in and let partners out, as outlined by the partnership agreement. Usually, the decision to add new partners requires approval from all the existing partners. The LLP itself is a flow-through entity for tax purposes, and partners receive untaxed profits and must pay the taxes themselves. In the context of a private company, becoming incorporated can provide its owners with limited liability since an incorporated company is treated as a separate and independent legal entity. An LLC is a corporate structure in the United States whereby the owners are not personally liable for the company's debts or liabilities. While the limited liability feature is similar to that of a corporation, the availability of flow-through taxation to the members of an LLC is a feature of partnerships. As an example, consider the misfortune that befell numerous Lloyds of London names, who are private individuals that agree to take on unlimited liabilities related to insurance risk in return for pocketing profits from insurance premiums. In the late 1990s, hundreds of these investors had to declare bankruptcy in the face of catastrophic losses incurred on claims related to asbestosis. Several company structures feature limited liability, including a limited liability company, an S corporation, and a C corporation. Partnerships may have limited liability partners, but at least one partner must have unlimited liability. Here are 3 key takeaways. 1. Limited liability is a legal structure of organizations that limits the extent of an economic loss to assets invested in the organization and that keeps the personal assets of investors and owners off-limits. 2. Without limited liability as a legal precedent, many investors would be reluctant to acquire equity ownership in firms and entrepreneurs would be wary of undertaking a new venture. 3. Several limited liability structures exist, such as limited liability partnerships, LLPs, limited liability companies, LLCs, and corporations. Hope this would help. Thanks for watching.